Well, it was another eventful day in the stock market. Unfortunately for the bulls, this time it was to the downside after we've had quite the nice run here in recent weeks. Time to give a little bit back. Of course, we got the news that Rex Tillerson would be removed from his post as Secretary of State. And many of you are familiar with his prior life with ExxonMobil, of course, big oil company. And so today's trade application example is going to come from that oil area. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's March 13th, 2018. Great to have every one of you on board here today, whether this is your first time checking us out or whether you're a longtime viewer of David and I's. Remember that you can subscribe to our YouTube channel by clicking that red button. You can even click on that bell icon to alert you whenever we upload videos. In addition to that, we'd love to see a thumbs up out of you if you do appreciate these videos on a daily basis. And we, of course, have a comments area down below that you can scroll to. And then lastly, we do have a description area where you're welcome to sign up for our daily email reminder and also includes the S&P 500 stocks that are giving you bullish and bearish clusters. Now, in addition to YouTube, David and I are both very heavy users of Twitter. I would encourage you to follow me at Brandon Van Zee, all one word. Our Market Scholars handle is at market_scholars. And remember that we always have our most recent Market Outlook video tweet pinned to the top of our timeline. And so we'd really appreciate it if you guys could click like and retweet if you get value out of these daily videos. I always strive to get at least 100 likes on a daily basis to make sure that our efforts are being useful here, as it does take quite a few hours to put these videos together. So we want to make sure we're reaching a broad audience with that. Thank you for those of you that do that on a daily basis. In addition to Twitter, we're also on Facebook. We have a Facebook group that you're welcome to join. You can see that address on the screen in front of you, and you should also be able to see that in the description area. All right, let's do some analysis on the markets here today. And as you can see, I've got the S&P 500 chart pulled up in front of us. We were down 17 points in the S&P 500. That was a 0.64% pullback. Now we'll see here in just a moment that the Nasdaq took an even worse hit. So things could have been worse for the S&P 500. But even still, I think most people, when they recognize this candle right here, they view it as a more bearish type of a setup, at least in the near term. Remember, our posture remains bullish. That's why the chart color is green here. Where we develop our posture from is the green line on the market forecast indicator that you can find on your Thinkorswim platform. And that green line is still trending up, meaning that from an intermediate term perspective, we remain bullish at this current time. But on a shorter term perspective, a near term line, that's your blue line right here, that is starting to show us some bearish conditions as we fell out of the upper reversal zone. So, you know, right now we got to be a little bit leery of this candlestick formation up here. It's entirely possible that, you know, for the next week or so, we're in the penalty box and we go back to that chop and slop that we've had since the fall out of the market here a month or so ago. And so we'll keep our eye on that. The other thing I'll point out is that the moving average itself here, this is the 30-day moving average, is still trending lower. Despite the nice move we had in price action in the last couple of weeks, the moving average, which is a trailing indicator, continues to drift lower. So that's not necessarily the best sign if you're bullish either. All right, let's take a look at our next chart setup, and this is going to be our 4-grid here. Again, using that market forecast indicator to kind of get our cues from. And what I wanted to point out was down below here, the Nasdaq in the lower left. You'll notice that was a pretty ugly day for the Nasdaq. It was down over 1% on the day. Now, before we get too worked up about that, we have to remember that the Nasdaq was really the leading index on the upside as well. So that happens quite often. You know, if something overshoots to the upside, it's often those types of charts that overshoot to the downside a little bit more as well. So I don't think I would read too much into that at this point compared to how I'd be comparing it to the S&P 500 or anything. In fact, you can see that despite the Nasdaq kind of taking the brunt of today's sell-off the worst, its chart could theoretically still be considered the most robust for the bulls. Reason I say that is that, you know, you look at this moving average tip, it's green, and that tells us that price is above a rising moving average. And you can just kind of see from the distance between where price is and that moving average, you have the biggest gap between those two right now, as opposed to something you look up here at the S&P 500. It's a little bit tighter. And then on the Dow, we're actually touching that 30-day moving average all of a sudden again. So that's not a good sign at all. So despite the bigger than average pullback in tech, I don't think I'd count them out yet. You know, there were some interesting things developing here within technology today. Many of you heard the news that the president was going to be blocking the Qualcomm and Broadcom potential deal there. And so I'm sure that probably created a little bit of havoc there within the technology space itself. Let's go ahead and take a look at our next charts, I should say. And this is going to be our charts that look at the 3 green arrows method. This particular chart setup will show us green charts when we have 3 green arrows in place. It'll show us red charts if we ever have 3 red arrows, which we do not right now. And then it'll show us white charts whenever we have a mix of green and red arrows. And that's what we do have with the Dow Jones right now, as you can see. We have a red arrow on the moving average, which tells us price is now below that moving average. And you know, it's also a falling moving average. And we can also see here that we've got a green arrow on the MACD and a green arrow on the stochastic. So 1 red arrow, 2 green. So it's a mix, it's more of a neutral. And that's kind of continuing our philosophy of what we just mentioned a moment ago with the market forecast charts, which is the Dow is the one that is the problem child right now. And this is probably still a carryover, a spillover effect for what's been happening tariffs-wise. You know, you'd have to believe that the mega cap companies that represent the Dow Jones Industrial Average are the ones that, if we do get into some sort of a trade war, they're the ones that are likely going to be hit the worst. They do the most global business. You think of Boeing as just one example, a stock that I talked about earlier today with some of you guys. And of course, Boeing is a huge exporter of airplanes all across the world. And so if all of a sudden we find that the walls are starting to close off around the United States, and we see protectionism all across the globe, it's possible. Now, I don't think it's necessarily likely, but remember, stock markets are a little irrational at times. It's possible that people will decide not to buy Boeing airplanes anymore. Now, the good news is Boeing is, of course, a world-dominating company, along with Airbus and a handful of others. And so at some point, you know, if a country needs an airplane, they might just have to pay the piper on that particular perspective there. So we'll see. The challenge, of course, with Boeing as well is, you know, that stock has just gone absolutely nuts to the upside for over a year at this point, doubled, nearly tripled in just a couple of years' time. And so part of the story, yes, may have been, you know, lighting that fire with the story headline of the tariffs, but another part of the story might be just simply the fact that Boeing's valuation has been so stretched, it's just waiting for an excuse to sell off. So we'll keep our eye on that story as well. All right, let's take a look at our next chart setup, and this is going to be our longer term setup here. This is our 1040 crossover method chart. And on these particular charts, these are 3-year charts that we're looking at here. Each one of the candles is 1 week in length. What we're looking for are crossovers of the moving averages themselves, which we haven't had for basically 2 years at this point on the major indices, meaning that had you gotten bullish on the markets 2 years ago when these 4 indices went and saw their 10-period moving average represented by the orange line cross up and through the black moving average line, which is your 40-period moving average, you would have been reasonably happy as somebody who would have been taking advantage of this full bull market along the way. So as it stands right now, not a whole lot to report on that count. You know, in fact, you know, from a weekly chart perspective, of course, Nasdaq hit an all-time high earlier this week. I had some fun talking to a few folks about my experience back in the dot-com days in January of 2000 when we were having a little chat earlier today. Let's go ahead and now take a look at our 12 grid. Now, this is your sector 12 grid here, and I do have to kill the camera feed so that way you guys can see the full monitor here of all these different charts. And we're back to the market forecast way of analyzing these charts, and in particular using that intermediate term line to determine our posture. And so as you look at these charts, you can see that it's mostly green across the board. We do have one exception there, which is telecom. And you know, keep in mind what I mentioned here in the past week, which is telecom. I always put an asterisk next to. It's kind of the odd man out. It doesn't really belong. If you notice, its ticker symbol is IYZ there. It's different than all the rest of the ticker symbols you see up here that start with X for their sector. The way that the sector selects spiders, which is the fund company involved in all the other sector ETFs, does it, is they put the 3 telecom stocks that are in the S&P 500 into technology. So Verizon, AT&T, and CenturyLink are part of XLK, even though technically telecom is a separate sector. So we kind of have to take that in stride and understand it's not a perfect analysis there. But just from a high level perspective, we do see a little bit of pressure there on some of your telecom players, according to this chart from an intermediate term perspective. The rest of the charts are holding up reasonably well. And again, your Nasdaq influenced XLK here, again, tech heavy, was one of the worst performers. In fact, the worst performer here today, down 1.15%. In fact, let's take a peek at our Market Watch tab here. And you'll notice that there were 3 sectors that were up today. And that's your XLRE, that's your XLU, and that's your XLV, and then followed by XLP. So real estate, utilities, healthcare, staples were our top 4 performing sectors here today. And of course, those are all your defensive sectors that are out there. David made a comment about that, considering that I was, talking about dividend aristocrat companies earlier today. There are days where investors are feeling more risk off than risk on. This is one of those days. And you can see on the bottom, we do have that technology area that's usually, kind of high volatility type of a sector that does really well when markets are going up, but can do somewhat poorly when markets are going down. They struggled the most today, down over 1%. And then financials also down over 1% here today. Let's take a look at our next set of 12 grids. And this is going to be our foreign markets 12 grids here. You can see it's a little bit more of a mixed bag across the globe than it is right now in the United States. We have a few more pink charts showing up here. And in particular, you'll notice that I intentionally structured the BRIC countries up here at the top. So for those of you that haven't heard that acronym before, BRIC, B-R-I-C, so Brazil, Russia, India, and China. And you'll notice that none of the charts look particularly good right now. The first 3 are pink, meaning we do have a bearish posture with that market forecast intermediate term line. And the 4th one here, China, isn't, I wouldn't go on record saying it looks rosy either. Yes, it does have a bullish posture, but you can see today's candle was pretty ugly. It did engulf yesterday's candle, bearish engulfing, and so we'll have to see kind of where that takes us going forward. As I look at those charts, one of them that does catch my eye is India right here, which I do have a lot of hope for long term. I think that is an economy that can really show some spectacular gains over the long haul. But right now, there just seems like there's something wrong. It's a broken chart. It's not a broken country, it's a broken chart. And you can see that when we spilled over big time earlier in the year, even here in the United States, well, India fell fairly dramatically at that time, and it just didn't recover the same way that that a lot of the other charts did, or at least the United States did. Notice that its price action has stayed below that falling moving average the entire time. Well, we did have this kind of counter trend rally taking place here over the last 5 days or so. But the problem is, you can see it came right up to this falling 30-day moving average, kissed it, and now hesitates. It's hesitating right at the level where you would assume there may be some resistance. That's not necessarily a good sign. So for those of you that are maybe a little bit more bold and looking to take some bearish trades, who knows, maybe India represents an opportunity to take a bearish trade at this point if you do believe that this is going to be seen as resistance going forward. Let's go ahead and now take a look at our final 12 grid here, which will be our intermarket analysis 12 grid. And again, by design, these are going to have more of a mixed bag almost every time we analyze them because they are not necessarily tied to the stock market. You're going to have some things like bonds or volatility or commodities or whatever it is that may be slightly different than what's going on with the stock market. So as it stands right now, we do have 3 green charts on our screen. We have preferred stocks up here at the top. We have U.S. government long bonds here in the middle, and then foreign bonds here in the middle as well. Of those 3 charts, the only one that looks moderately interesting from a trend perspective is foreign bonds. I mean, that's a decent setup there. It's not great, but at least it's sideways. It's trending sideways, whereas a lot of the other charts that we see on our screen in front of us have been largely trending lower over the last 3 months. The other one that I've been mentioning a lot here in these market outlook videos recently is ag commodities down below. Now, do recognize that the posture is bearish right now. That's what that pink chart tells us. But last week when I did the video, I said, watch out. This is a smooth looking chart. It's a nice looking trend, and it's entirely possible it's just setting up for some sort of a bull flag. Well, it almost looked like it wanted to perform that here for us today. And you can see it was up, so that's a good sign. It was up on a day when a lot of the risk appetite across the markets was down, but it didn't close near the highs of the day. This would be a much more emphatic bullish story if it had closed at the highs of the day, because then it starts to look like it's breaking out of that very small downward diagonal channel that it's had in the last 4 or 5 sessions, and possibly breaking out of that bull flag. So keep your eye on that one. We're still not to the point where you can necessarily trust it, but I do like the shape of that trend and how it's been so consistent here recently. And then lastly, I do want to point out crude oil. Notice crude oil, its neighbor here to the right of it, that's /CL in this particular case. That's your futures contracts here. Crude oil's not looking so hot. We had a nice run out of crude oil at the beginning of the year, but as the stock market fell, we found that this commodity has struggled to a degree as well. And you'll notice that that moving average is slumping over. It's red, telling us that price is currently below that moving average. And somewhat similar to India, you can see it's really struggled to get up and through that moving average. It attempted it on these days right over here, but it just didn't have the oomph to carry it further. It only could stay up there a day or two before falling over again, and then every other time it's touched that moving average, it's struggled to cross through it. So I thought we would focus on that today. Mentioned the Rex Tillerson news in the intro. I have no idea if that's part of the reason that crude oil was down 0.7% today or not. But nonetheless, it's a chart that doesn't look all that strong right now. And so it might give us an opportunity to practice a trade on crude oil. Now, what I'm going to do is I'm going to come over here to just a regular chart, market forecast chart, and I'm going to type in USO. I personally don't trade options on futures. Some of you might, and that's fine. I should probably, look into doing that myself at some point. I just haven't taken the dive on doing that yet. It's something that maybe I'll explore later. So for those of you that feel comfortable with the idea of options on futures, by all means, practice this mentality using /CL. But for our purposes here, I'm going to try to keep it a little bit more simple on this video, and I'm going to use USO. Most of you are familiar with that ticker symbol as being an ETF that tracks, or at least attempts to track, the price of oil. And so you can see what that chart looks like here. It looks much the same as the chart that we were just looking at a second ago with /CL. And so what I thought we would do here today is let's come over here to the trade tab. Now, first of all, recognize this is a low price security. It's only a $12 security, but it is heavily traded. You notice that the open interest here is in the tens of thousands of contracts. It's not just in the thousands, it's in the tens of thousands. And I'm looking at the April contracts, the monthlies here that have 38 days until expiration. We have tons and tons of people that are trading these particular contracts right here. But the reason I'm pointing out that it's a low price security is because you'll notice something a little bit different with this one compared to a lot of them that you might be looking at, which is it has 50-cent increments between its strikes. If you look at this, it says 11.5 to 12, 12.5 to 13, 13.5, and so on. So keep in mind that when you're doing strategies like this, you might get return on risk that are attractive, and I'll show you that in here in just a moment. But the downside is when you're doing spreads on 50-cent increments, it usually requires you to ratchet up the amount of contracts you're going to do to make the trade worthwhile for you. I can't speak for everybody there, but just I'm pointing out the potential weakness of this trade. And for some of you, it's not going to be right. For those that just want to practice, that's what this is an educational video. For those that want to practice a bearish strategy using paper money, I think it's fine. Some of you that are doing real money stuff, you'll have to make that determination on your own. We could go either way. We could either buy a put spread or we could sell a call spread. I'm kind of comfortable with either one of those ideas at this point. This is kind of more of a sideways trending security right now, and so I guess right now maybe I'll see if we can get the bear call spread to work first. If it doesn't, then I'll explore the long put spread. So let's start with the bear call spread. And so I'm going to come over here to the call side of the equation, and I'm going to look for a call to sell. And so in that case, it looks like it's going to be $12.50 is the strike price of the call I'm going to sell. And I'm going to sell a vertical. So I right-clicked and I went to sell a vertical. So I've pulled up this spread here. And again, recognize we got $12.50 call that we're selling, $13 call that we're buying. And we're getting a spread of 15 cents. Now, most of you are familiar with getting a dollar-wide spread, and you know that the credit that we're seeking is 24 cents. And so it's natural to assume, without even doing the math, that if you're doing a 50-cent spread, that your new bogey is 12 cents. It's just half of that 24 that we'd normally be looking for. And if we're getting 15, that's way more than we need. And so let's just confirm that to verify. I'm going to click confirm and send once. And you can see that we're basically going to take in a profit of $15. We have the potential to lose 35. And if we do the math there, so we take $15, and again, this is just one contract. Feel free to adjust the contracts for your position sizing however you want. But 15 divided by 35 is a return of 42.8%. Anything over 30% captures my attention. So I'm certainly comfortable with that particular aspect of this trade. So then maybe we can kind of eyeball. Remember that our break even would effectively be 15 cents plus $12.50 in this case. So theoretically, our break even is $12.65 on this chart. If we come over here to the chart, let's see where $12.65 is. And you can see it's about right here where the black mouse on the screen is pointing. That's $12.65 right there. So it is slightly higher than this resistance area that we had over here for a couple of days, but it's not quite as high as what some of you might view a resistance area over here. Generally speaking, I'm comfortable with that. Remember, the idea here, as long as it goes sideways down or up just a little bit, as long as it doesn't skyrocket higher, then this can be a trade that we can win. So I'm going to go ahead and click on confirm and send, review that one last time, and we'll ship that particular trade in. One other thing I wanted to mention, I just happened to glance at this. I don't look at these all the time, but you guys will recall that Amerisource Bergen was a trade that we did. When was it? February 21st. And we did it was kind of a unique trade where we were doing a covered call at the money. So it was a trade where we decided we wanted to take in more credit than we normally would when we sell out of the money strikes. And it was a trade that really struggled from the get-go. Let's take a peek at the chart here. You'll notice when I put the trade on, that would have been on the 21st right there. Remember, a covered call trade is a trade that you want to be moderately bullish. And so what we found is that didn't happen. And that happens often. Trades don't go your way every single time. Obviously, most of you are aware of that. Well, this stock that was trading right around $100 at that time when we sold the $100 strike ultimately went down to 92, because in the middle of that period between now and when I originally put that trade on, the merger that was in the works with this company was called off. So that was looking really nerve-wracking there for a while. I've been pleasantly surprised and pleased to see that this thing has gone up since then. So remember, this one was one where we were comfortable taking the trade and getting called out. We were really just trying to tap into the credit itself. Right now, this stock has gone from 92 up to 100.6 in the last few weeks, and we only have 3 days left until expiration. If this stock closes above 100 on expiration day, our 100 shares will be called away, and we'll basically take in and keep the credit that we received when we sold the call in the first place. So right now, our P&L is up to about $241. So that was an example of a trade where patience did pay for us. And keep in mind, it doesn't always have to work that way. But I was somewhat surprised and thankful to see that coming through for us here in the end. If it does close below 100, maybe what we'll do in a future video is sell another call against it and see if we can keep on taking in some premium along the way. I'm comfortable either way on something like that. All right, so that does wrap things up for us for the day. Appreciated you guys tuning in here tonight. Appreciated some of the back and forth and engagement I've had with a few of you guys here in the last week or so. It's been a fun week of development here at Market Scholars. So remember, if you get value out of these daily free videos on YouTube, make sure you click the thumbs up on YouTube and you give us a like and a retweet on Twitter as well. I will be off for the rest of the week. I've got a little bit of a trip planned. I'll be heading out of town, and so David will be with you the rest of the week on the Market Outlook videos, and then I plan on being back here next Tuesday for this video, so I look forward to seeing y'all then. Of course, enjoy the NCAA basketball tournament along the way. I affectionately call it the most wonderful time of year. So with that, have yourself a great day. Best of luck with your trades and your investments. Goodbye for now.